Welcome to Breaking News to Trading Moves. Today we're looking at a headline that, well, it's certainly catching eyes in the consumer goods world. Mars looks set to get unconditional EU approval for its big acquisition of Kellanova. We're talking about a $36 billion deal here.
Yeah, that's the report. And it's a key piece of news because U.S. regulators, they've already given it the green light. So if the EU follows suit with this unconditional approval, which we might see decided by, December 19th, then that basically removes the last major regulatory question mark hanging over this thing.
And it is a massive deal. When you put Mars and Kellanova together, what kind of market share are we looking at?
The projections suggest they'd control something like 12% of the U.S. snacking and candy market, a pretty substantial slug.
12%. Okay, so what we want to do now is move beyond just the headline. We want to figure out the immediate market reactions based on the analysis that's out there. Identify the groups, the companies that are seen as winners and maybe losers from this regulatory development.
Exactly. And that word unconditional is really important here. It means the EU regulators apparently didn't see a need for Mars to sell off parts of the business or change how they operate to get approval. That takes a lot of the will it actually happen risk off the table. And that certainty itself, well, that moves markets.
Okay, let's start with the winners then. Who stands to benefit from this clearance and maybe the renewed confidence it brings to the CPG sector? Seems like there are a few different groups cited.
That's right. The first group often mentioned involves the event-driven and arbitrage investors. ARBs, they're often called. And alongside them, you could put the big established large-cap snack companies.
Okay, explain that a bit. For the arbitrage folks, how does this news help them?
Well, when a deal like this is announced, the target company's stock, Kellanova, ticker K, in this case, it usually trades a bit below the actual price Mars offered.
Right, there's always that gap, that spread.
Exactly. And that spread exists mainly because of risk. The risk the deal falls through, gets delayed, or maybe regulators demand painful changes. With both U.S. and, it seems, EU regulators giving unconditional approval, that specific regulatory risk just kind of evaporates.
Ah, okay. So the ARBs who bought Kellanova stock, ticker K, hoping the deal closes at the full price.
Their bet just got a whole lot safer. The market sees the deal as much more certain, so that spread between Kellanova's price and the deal price tends to shrink fast. Their position gets de-risked almost instantly.
Makes sense for Kellanova, K, as the target. But the analysis also mentions PepsiCo, ticker PEP. Why would a giant like PepsiCo benefit here? They aren't part of this deal.
It's more of a sector-wide sentiment thing, seeing a huge $36 billion deal go through smoothly without major regulatory fights. It suggests the environment for big M&A and consumer goods might be, let's say, more accommodating than perhaps feared.
So it boosts confidence that other large companies like PepsiCo, PE, could also pursue big deals without hitting massive roadblocks.
Precisely. Investors might look at the whole sector and think, okay, consolidation is still possible, even at this scale. And that perception, that confidence, can actually help lift the valuation multiples across the board for major players like PEP.
Okay, that covers the investors and the big players. What's the second group of winners identified?
That would be the U.S. consumer M&A advisors. Think the investment banks that structure and guide these huge transactions.
Yeah, the deal makers themselves. So Goldman Sachs, GS, and JP Morgan Chase, JPM, are mentioned.
Yes, firms like those. When a deal this size clears regulatory hurdles cleanly, it's great advertising for the advisors involved. It signals their expertise in navigating complex approvals.
And what does that signal do for their future business, their pipeline?
It can definitely encourage other companies thinking about deals. Look, M&A can slow down if everyone thinks regulators are going to block everything. Seeing Mars Kellanova succeed, potentially without conditions, suggests that big strategic CPG deals are still feasible. That keeps the pipeline active for firms like GS and JPM, which means more advisory fees down the line.
Right, one successful deal can breed confidence for the next one. Okay, and the third group of winners. This one shifts gears a bit, doesn't it? Contract logistics and parcel services.
Yeah, this moves into the operational side of things. Merging two big companies like Mars and Kellanova means merging two separate, complex supply chains.
Which sounds like a headache, but also an opportunity.
Absolutely, an opportunity for optimization. You've got warehouses, trucking routes, co-packing facilities, all needing integration. And that process often benefits the big logistics providers.
How so? Does the sheer volume help them?
It's about consolidation. Instead of dealing with Mars and Kellanova separately, logistics firms now have one giant customer. This new, larger entity will likely want to streamline everything, fewer warehouses, more efficient transport lanes. They'll look to consolidate those contracts.
So companies like XPO, that's ticker XPO, and FedEx, FDX, might be bidding on fewer but much larger, potentially more stable contracts.
That's the idea. For logistics providers, predictable, high-volume business is key. Servicing one huge integrated network for Mars Kellanova can lead to better utilization of their trucks and warehouses. These large consolidated contracts are often very valuable, sometimes more efficient to manage than two smaller separate ones.
Okay, that makes sense. So we've covered the groups seen to benefit from the deal's likely clearance. Now let's flip the coin. Who might face some pressure or find themselves in a tougher spot because of this newly combined larger supplier?
Well, the analysis typically points first towards grocery retailers. This is a classic outcome of supplier consolidation. We're talking about companies like Kroger, ticker KR, and Albertsons ACI.
And this comes down to bargaining power, right? A supplier controlling 12% of the snack and candy aisle just has more clout.
That's exactly it. Leverage. The combined Mars Kellanova entity simply has more negotiating power when dealing with retailers. They can push harder on what's called trade terms.
Trade terms. Okay, let's break that down. What kind of leverage are we talking about, and how does it impact, say, Kroger's bottom line?
Trade terms cover a lot. Things like promotional funding, how much Mars Kellanova contributes to sales events or displays in the store, also sliding fees payments for getting the best shelf space, and importantly, payment schedules.
Ah, so they could demand retailers pay them more slowly.
Potentially, yes.
Yeah.
If Mars Kellanova becomes a must-have supplier with all those popular brands, they might negotiate longer payment cycles.
Hmm.
That helps Mars Kellanova's cash flow, but ties up the retailer's capital. They might also push retailers to accept less money for promotions, which directly squeezes the retailer's profit margin on those items.
So even if the snacks are still on the shelf, the profitability for Kroger, KR, or Albertsons, ACI, gets tougher because the supplier has more power in the negotiation.
That's the pressure point. It forces retailers into difficult decisions about pricing, or maybe even which smaller brands they carry, just to protect their margins. It was apparently a point of discussion during the regulatory review, too.
Okay, retailers are one group. Who else faces pressure? What about direct competitors?
Yes, the other snack and candy companies.
Hmm.
This seems pretty direct, right? More competition. Think about Mondelez International, ticker MDLZ, and Hershey, HSY.
What specific pressure do they face beyond just having another big competitor?
It's about the scale and breadth of the competitor. Mars Kellanova won't just be bigger. They'll have combined resources for marketing, for product development, for sales teams. They'll have a wider portfolio: chocolate, candy, cookies, salty snacks.
So it's harder to compete for shelf space, like a battle for store real estate.
Definitely. The snack aisle is already incredibly competitive. This combined company can likely fund bigger, more coordinated marketing campaigns across different types of snacks. A company may be more focused, like Hershey, HSY, primarily in confectionery, or Mondelez, MDLV, fighting on multiple fronts already, might find they need to spend even more on advertising and promotions just to hold their ground.
And spending more on marketing can eat into their own profits.
It certainly can. It raises the cost of competing effectively.
Okay, that makes sense. So retailers feel the bargaining pressure, competitors feel the market pressure. Is there a third group?
Yes, the analysis also points upstream to the packaging and ingredient suppliers.
Ah, the companies that sell to Mars and Kellanova. So like Amcor for packaging, AMCR, or Ingredient, INGR for ingredients.
Exactly those types. It's sort of the mirror image of the retailer situation. Now, instead of two large customers, these suppliers face one giant customer.
So even if the total amount of packaging or corn syrup they sell goes up because the combined company is bigger,
The negotiating leverage shifts again. The mega buyer, Mars Kellanova, is now in a position to demand better pricing from suppliers. They can push for longer-term contracts at lower rates, maybe demand stricter terms.
so it squeezes the margins of suppliers like Amcor, AMCR, and Ingredient, INGR.
It can, yes. They want to keep that huge volume of business, obviously. Mars Kellanova become a critical account. But to keep it, they might have to accept lower prices or tougher conditions, which pressures their own profitability.
It's a tough spot, needing the volume but potentially sacrificing margin to get it.
It often is for suppliers when their customer base consolidates like this.
Okay, this really paints a picture of the different effects rippling out from this expected regulatory approval. On one hand, you have the deal certainty helping Kellanova, the ARBs, maybe boosting sector confidence, benefiting PepsiCo, PepP. Plus, the M&A advisors like Goldman Sachs, GS, and JP Morgan Chase, JPM, see validation, and logistics firms like XPO, and FedEx, FDX see consolidation opportunities.
Right. But then on the other side, that very same scale creates challenges. Retailers like Kroger, KR, and Albertsons, ACI, face tougher negotiations. Competitors like Mondelez, MDLZ, and Hershey, HSY, face a stronger rival. And suppliers like Amcor, AMCR, and Ingredient, INGR, face increased pricing pressure from their now much larger customer.
It really illustrates how a single large transaction can create winners and losers all through the supply chain. So here's a thought to leave everyone with. We've talked about how this bigger supplier gains bargaining power over retailers. Thinking longer term, how might that dynamic eventually play out on the grocery shelf for you, the consumer? Could it influence the variety or even the cost of the snacks we see? Something to think about.
Definitely something to watch.
This is not financial advice or a recommendation to buy or sell any security. The views presented here are purely the opinion of the author.